Hi there, I'm Alan Gauld. I'm a Senior Investment Director in the Aberdeen Private Equity team and Lead Portfolio Manager of Aberdeen Private Equity Opportunities Trust, or APO for short. So what I would say up front is that we are very confident in the valuations in our book. There's a lot of scrutiny on those valuations. The APO portfolio is a buyout portfolio, so that means that they're companies majority owned by private equity firms that are typically well-established, institutional, cash-generative businesses. So, and those businesses are revalued every quarter bottom up. The thing that really gives me comfort is the governance around private equity valuations. So, as a modern-day institutional-grade private equity manager has a lot of governance around the valuation process. So that sort of negates this idea that somehow private equity managers are refusing to mark down their book. All of the managers in the APO portfolio revalue on a quarterly basis bottom up. All of them report or value in line with international private equity and venture capital guidelines. All of them are in line with IFRS or US GAAP accounting standards. And importantly, all of the underlying investments are audited at least annually by the fund's auditors. Now, you add on top the fact that with APO, our auditors indeed look at the valuations again on a sample of the largest positions in the book. The scrutiny from us as a manager, the scrutiny from the audit committee, who we formally present to every quarter on the valuations. So the governance is multi-layered, and the idea that somehow everyone's asleep at the wheel, I think, is somewhat far-fetched. And I'd also say, in terms of the incentive for private equity firms to overvalue, it just really isn't there. Private equity firms typically charge their fees on commitments or on cost, not on value. So there's no kind of fee element sort of driving valuations. And also their performance fee, their carried interest, as it's known, that is on realizations, on cash coming back. That's how that's measured. So there really isn't an awful lot of incentive for a high-quality private equity firm to overvalue. So that's the first thing I say. The governance is very, very strong. The other thing I would point out is that earnings growth in our portfolio has been quite strong, actually, over the last wee while. So if we look at our top 50 companies, which equate to around 42% of the portfolio, EBITDA in the last 12 months to 31st of March grew 29%. So that's helping drive valuations as well, a strong earnings growth. Now, why have private equity-backed assets been able to grow that strongly? Well, I would say there's an element of the comparative numbers perhaps being a little bit weak post-COVID. There's an element of that. We have to be transparent about that. But I also think private equity changed an awful lot following the global financial crisis. It changed its focus by sector. Historically, there was a lot of industrial, a lot of manufacturing businesses, a lot of casual dining roll-ups, bricks and mortar retail. And now it's a lot of non-discretionary type sectors. So a lot of tech and healthcare, a lot of consumer staples, essential business-to-business services businesses. And that makes up the majority of our portfolio now. Businesses that have market leadership and pricing power. So that certainly helped. And as an example, 10 years ago, the healthcare sector was 6% of APO's book. Now it's over 20%. So, more secular growth sector focus has certainly come into play. But also, private equity firms as well have really increased their capabilities around value creation. Most firms now have an in-house consultancy, effectively, full of functional expertise, whether that's sales and pricing, whether it's digitization, ESG, cybersecurity, procurement, whatever it may be. They have experts on board on the payroll, and they know the right consultants as well, should they need additional support. So they're a lot more active, and I think that's one of the strengths of the private equity model is the governance model. The fact that private equity firms do, in fact, own the majority of the company and can take an active role, sit on the board, and really influence strategic direction and value creation. So those are two big differences, the sectoral and also the value creation part. So earnings have been strong, governance is good. The question then is, well, what about the multiple that private equity firms use to value. Surely that's come down with what's happened in the public markets, and it has, but probably not as much as you would think. If we look at our top 50 again, and it's not a like-for-like comparison because the top 50 does change a little bit from period to period, but the value on average, or the median multiple, was around 16 times 12 months ago, and now it's just above 14 times. So there has been a contraction in the valuation multiple in our largest assets. But it's important to recognize how private equity values. So typically they use a basket of listed comparables, similar businesses on the stock exchange, as a sort of valuation proof point. And they apply a discount, usually for illiquidity reasons, to this basket. And then some also include transaction comparables, which private transactions, in the private equity space, to also feed those into an average or a median multiple that they use to value their businesses. And those transaction multiples tend to be longer term in nature, but also businesses that are probably more appropriate in size and growth with the business that they're valuing. And that effectively creates a little bit of a buffer with public equities. And how that manifests itself, the best way to explain it, or to show you how this has worked, is the fact that over the last 10 years, and in fact longer than that, when a private equity firm sells a business, it has done so at an uplift, which I think shows the conservative nature of the valuations over that time period. So the average uplift in our book, as I mentioned earlier, is around 25% when compared with the unrealized value 2 quarters prior. That's over the last 10 years. And in fact, Bain & Co did some analysis in their global private equity report where they showed over 70% of exits were in excess of the valuation 1 quarter prior. So there's that uplift upon exit, which shows that valuations have been relatively conservative in the buyout space. So I think that there is a fair argument, just to sort of round this off, there is a fair argument, are private equity valuations still as conservative now? And frankly, that's still a bit of an open question. We don't really have enough proof points yet post the war in Ukraine and the change in the markets to demonstrate this with great certainty. But from the exits we have seen, they remain at an uplift. So there's some big exits in Europe with the likes of HG selling Transporion, with the likes of Nordic Capital selling the Binding site, with the likes of CVC selling April, all at uplifts to the unrealized valuation 2 quarters prior. So it seems to still be there, but we need a few more proof points in the market in terms of exits to come away with any sort of conclusion. So in summary, long-winded, but in summary, very confident on the valuation of the book. The question now, which I think is a valid question, is whether private equity valuations are as conservative now as they were in the last 10 years. And hence, will the uplift upon exit be 25% going forward, or will it be something a bit more modest in sort of 10, 15%? And that we don't have a definitive answer to, and only time will tell.